How history can help you invest. Imagine being able to predict crises, financial bubbles, and even opportunities to amass wealth, not with a crystal ball, but simply by studying the past. Have you ever stopped to consider why so many fortunes were born precisely during periods of economic chaos? Or why mistakes made centuries ago continue to repeat themselves on today's stock exchanges? History is not just a collection of ancient facts. It is a veritable hidden manual for understanding the movements of money, markets, and the human mind. From the times when tulips were worth more than houses to the days when banks collapsed due to unmanageable debts, there is a pattern that repeats itself. And if you learn to see these signs, you can protect and even multiply your wealth. In this video, we will explore how history can be the key to investing intelligently. Prepare to travel through time and see today's markets with new eyes. Stay with me until the end and discover lessons that can transform the way you invest. The relationship between history and investments is much deeper than it appears. Each crisis, each collective euphoria, each financial collapse has left marks that still shape today's market. To understand this, we need to go back to the 17th century in the Netherlands, where the famous tulipomania occurred. Exotic tulips began to be traded as symbols of status and wealth. The price of a single flower reached the equivalent of a luxurious house in Amsterdam. The frenzy was so great that entire families sold everything to buy bulbs, believing they would quickly become rich. But what seemed like a safe investment turned into tragedy. When prices plummeted, fortunes disappeared overnight. This episode, despite being ancient, reveals something essential. Collective greed can inflate bubbles that inevitably burst. Today, just look at cryptocurrencies, the dot-com bubble of the 2000s, or even the real estate speculation before 2008. The pattern is the same: irrational enthusiasm followed by collapse. Another striking example comes from the Great Depression of 1929. The 1920s in the United States were a time of prosperity. Easy credit allowed ordinary people to invest in the stock market with borrowed money. It seemed everyone could get rich. Until October 1929, when the market went into a free fall. Banks collapsed, millions lost their jobs, and the world plunged into one of the worst economic crises in history. The lesson here is clear. When the economy grows too quickly and people start to believe that prices can only rise, it's time to be suspicious. Blind euphoria is the enemy of the prudent investor. Even in times of war, history shows how investments behave. During World War II, governments printed excessive money to finance the conflicts, generating inflation in several countries. In contrast, assets like gold appreciated, showcasing their strength as a store of value. The same pattern repeats today, in times of global instability. When there is uncertainty, investors flock to assets deemed safe. These episodes teach us that history is not merely a memory, it is a mirror that reflects human behaviors regarding money. And understanding these behaviors is a crucial step to invest better. From these examples, we perceive that history not only shows what has already happened, but anticipates what may recur. After all, human nature does not change. We continue to be driven by fear, greed, and hope. This is what fuels bubbles, crises, and opportunities. Consider the case of the dot-com bubble at the end of the 1990s. The internet was the great promise of the future. Any company with a .com in its name received million-dollar investments even without real profits. Stocks soared, creating a wave of optimism. But in 2000, reality knocked on the door. Most of these companies could not sustain themselves, and prices plummeted. Investors lost billions. But those who studied previous episodes, such as the tulip mania or even the euphoria before 1929, could have identified clear signs: exaggerated promises, unrealistic valuations, and excessive collective optimism. These signs remain valid today when new technologies emerge and attract desperate investors who do not want to miss out. The same applies to the 2008 crisis. It was not merely an accident, it was the result of years of easy credit, speculation in the real estate market, and blind trust in financial institutions. Those who knew history and had learned from 1929 could, at least, suspect the unsustainability of the system. Indeed, a few investors who looked at the signs became billionaires by betting against the market. But history also teaches about resilience. After each crisis, markets recover. After 1929, the New Deal and new rules for banks and exchanges emerged. After 2008, stimulus policies and financial reforms remodeled the system. Those who remained calm and did not sell in desperation eventually reaped the rewards years later. Another important point is geopolitics. In the 20th century, wars and shifts in power among nations showed how assets like gold, oil, and even currencies could drastically change in value. Today, with international tensions and new economic blocs emerging, history offers clear parallels. Those who understand these cycles can invest not only in numbers but in contexts. Therefore, the impacts of history on investment are not just in the past, they are alive in the present. Each new euphoria, each new collapse, and each new recovery follow the same patterns. The attentive investor doesn't need to predict the future, they just need to recognize the echoes of the past. If there is one incontestable truth in the world of investments, it is this: the market changes, but human nature does not. Fear and greed continue to be the engines of the economy, and history shows us this repeatedly. From tulip mania to cryptocurrencies, from the Great Depression to the dot-com bubble, from golden wars to the 2008 collapse, the patterns are always there, visible to those who wish to learn. The great lesson is that investing is not just a matter of numbers, charts, and indicators. It is, above all, understanding behaviors. When we see that collective euphoria always precedes a collapse, or that solid value assets tend to survive crises, we can make smarter decisions. Of course, history does not repeat itself identically, but it rhymes. Each crisis brings new details, but human errors and excesses remain the same. Therefore, studying the past is like acquiring a secret map to navigate the present. If you want to become a more conscious investor, start looking back before betting on the future. Ask yourself, at what point in history has this already happened? Which signs are repeating now? And what can I learn from it? This reflection not only protects your assets, but also opens doors to opportunities that many ignore. After all, while the majority is swept away by euphoria or panic, those who have learned from history know how to keep calm and act strategically. And now, I want to hear from you. What historical lesson has marked you the most, and do you believe it is useful for investing today? Share your opinion in the comments, subscribe to the Mundo Enriquecedor channel, and turn on notifications. And if you want to delve even deeper into curiosities about finance, currencies, and the economy, also watch the recommended videos on the screen. After all, the future of your investments may be written in the pages of the past.